Let us see the next question. X Limited is likely to have following, highlight the portion, real cash flows. Cash inflow is provided to us for first year end and second year end. Outflow is given for the first year end and second year end. For inflow, inflation rate is 5% and 10% for year 1 and for year 2 respectively. For outflow, inflation rate is 6% and 8% for year 1 and year 2 respectively. Discounting rate or the cost of capital is given 25%. Calculate NPV of the proposal. Company is required to make investment of 10,000 rupees and discounting factor of 25% is given for the first year and second year. That is parts of the question information. I request all of you to go through the question, please. Dear students, over here we can see that say one of the unique feature is that say the inflation rate is changing. Whenever there is a different inflation rate for different years, or there is a different inflation rate for the different element of the cash flows, then always remember that whatever the cost of capital which is given to us in the question is always the nominal cost of capital, in a way that so we understand that say over here that say from overall business what is your expected rate of return is provided to us say as 25%. We have to always understand that say when inflation rates are different for the different element of the cash flows, or inflation rates are different for different years, the given cost of capital is nominal cost of capital. Because from the basket of the products, you always have only one inflation rate, you have only one nominal cost of capital. So this nominal cost of capital is determined using the real cost of capital and using the general inflation rate. Please write an answer. Whenever there is a situation in which inflation rate is different for different years or different for different element of cash flows, comma, then the given required rate of return is considered to be nominal cost of capital. Full stop. Heading right down. Nominal cash flow approach for decision making. In that write down, step number one, investment. Friends, amount of investment is 10,000 rupees. Step number two, depreciation. Friends, over here we can see that directly or indirectly we have not been given any tax information. So we'll ignore depreciation. Step number three, terminal cash flow. No terminal cash flow information is given, so it is zero. Full stop. Step number four, calculation of recurring cash flow. Dear students, I want you to write in the chat box what would be the recurring cash flow for the first year end and for second year end. Now friends, over here we are required to mention two things. One thing is inflow and another is outflow. First year inflow is provided to us as 30,000 into 1.05. Second year it is again 40,000 into 1.05 into 1.10. Because we know that the inflation rate is on annually compounded basis. Outflow. First year outflow is 12,000. Inflation rate for the first year is 6%. Second year cash outflow is 18,000. And second year inflation rate is 8%. So please use your calculator. 30,000 into 1.05. That comes to 31,500. 12,000 into 1.06. It is 12,720. So based on this, we compute the net cash flow. It is 18,780. This is of the first year end. Second year it would be 40,000 into 1.05 into 1.10. That is 46,200. 18,000 into 1.06 into 1.08. 20,606.4. So it is 25,593.6. This is the way the net cash flow will be found. Now step number 5 is NPV calculation. In that case, first year and second year cash flows have been calculated by us. It is year 1 and year 2. 18780, 25593.6. It will be discounted at 25%, that is nominal cost of capital. Then present value. 18780 into 0.8, 15,024. 25593.6 into 0.64. 16,379.90. So total of both of them is present value of cash inflow 31,403.90. Amount of investment is 10,000. That is the way the NPV is formed. As NPV is positive, we would advise the company to purchase the machinery. So write down our final answer. As NPV is positive, comma, the company should purchase machinery. Full stop. Okay. Now, friends, there are very less chances that the question may provide us, let's say, do the answer in the real approach. But if at all such kind of question is there, then how to do answer, that is dictating that to you. Now write on heading real cash flow approach. In the write down step number 1, investment rupees 10,000. Step number 2, depreciation, ignore. Step number 3, terminal cash flow 0. Step number 4, recurring cash flow. First year and second year, inflow is 30 and 40. We don't have to consider inflation. Outflow is 12 and 18. Net cash flow 18,000 and 22,000. That is the way the real cash flow will be found. Okay. So now step number 5 is NPV. Now dear students, for the purpose of NPV calculation, understand that we are adopting the real cash flow approach and we have the nominal cost of capital. So we have to compute the real cost of capital. So calculation of real cost of capital. We'll do it for inflow first of all, and then we will do it for outflow. 1 plus nominal is equal to 1 plus real into 1 plus inflation rate. That is what the simple formula. As far as year 1 is concerned, 1.25 is equal to 1 plus real into inflation rate for the first year is 5%. So real cost of capital is 1.25 divided by 1.05 minus 1. So please use your calculator. 1.25 upon 1.05. Whatever the answer, minus 1 into 100. 19.05%. That is for year 1. We have to do it for year 2 also. Just I want to know, can you tell me that, say, what would be the real cost of capital for second year? So friends, for the year 2 it will be like this. Understand carefully, dear students. It is 1 plus nominal cost of capital raised to 2 is equal to 1 plus real cost of capital for the first year into 1 plus real cost of capital for second year into 1 plus inflation rate for the first year into 1 plus inflation rate for the second year. This is the way it will be calculated. So it is 1.25 raised to 2 is equal to 1.1905 into 1 plus r for the second year into 1.05 into 1.10, because for inflow the second year inflation rate is given to us as 10%. So now what will happen, dear students? It is 1.1905 into 1 plus r is equal to 1.25 raised to 2 divided by 1.05 into 1.10. So again 1 plus r is equal to 1.25 raised to 2 divided by 1.05 into 1.10 into 1.1905. So r is equal to 1.25 raised to 2 divided by 1.05 into 1.10 into 1.1905, whatever the answer, that's a we get minus 1. This is the way we are required to find answer. 1.25 square divided by 1.05 divided by 1.10 divided by 1.1905, whatever the answer, minus 1. That comes to 13.63%. So this is the way the real rate of interest for inflow for the second year will be found. Same copy paste for outflow. And this is for inflow. Similarly, we have to do it for outflow. Of course, the formula is not going to change. For outflow, again we will have year 1. 1 plus n is equal to 1 plus r into 1 plus inflation. So r is equal to 1 plus n divided by 1 plus inflation whole minus 1. So it is 1.25. Now what is the inflation rate for outflow for the first year? 6%. Whole minus 1. So 1.25 divided by 1.06 minus 1 into 100. 17.92%. That is the real rate of interest for the first year. Similarly for year 2, 1 plus nominal raised to 2 into 1 plus real for the first year into 1 plus real for the second year into 1 plus inflation for the first year, 1 plus inflation for the second year. So it is 1.25 raised to 2, 1.1792, 1 plus R for the second year. Second year inflation rate is 6%. Second year inflation rate is 8%. One point 1792, 1.06, 1.08, whole minus 1. That is the way we will find answer. 1.1792, 1.06, 1.08 minus 1. It is 15.75%. That is the way it can be calculated for second year. Now once we make this two calculation, afterwards we'll make the calculation of NPV. I want you to calculate the NPV and put your answer in the chat box. So let us see how to calculate the NPV. Column number 1 is year 1, inflow. As far as the inflow is concerned, it is 30,000. Present value factor. For year 1, present value factor is 19.05%. 1 divided by 1.1905. Okay. Second year again there is a cash inflow. How much? 40,000. 1 divided by 1.1905 into, as far as the second year factor is concerned, it is 13.63. 1.1363. That is the way the second year factor will be found. So use your calculator. 1 divided by 1.1905. So it is 0.8399, that is 84 paise. Now 1 divided by 1.1905 divided by 1.1363, that is 7392. Now outflow. First year end it is 12,000. Oh, sorry. Outflow. First year end it is 12,000. And for the second year end it is 18,000. Again it will have the discounting. Present value factor for the first year is 17.92%. So 1 divided by 1.1792. Second year it is 1 divided by 1.1792 into Second year factor is 15.75 percentage, 1.1575. So again use a calculator. 30,000 into 0.84, so it is 25,200. 40,000 into 0.7392, 29,568, plus 25,200. So present value of the cash inflow 54,768. Outflow 1 divided by 1.1792, it is 0.8480. Second year it is 7292. Again present value 12,000 into 0.8480, so 10,176. 7292 into 18,000, so it is 13,125.6 plus 10176, 23301.6. So this is the way the present value of the cash inflow and present value of the cash outflow will be found. The final answer would be NPV. As far as NPV is concerned, present value of cash inflow minus present value of cash outflow. 54,768 minus 23,301.6 minus 10,000. 54768. So it is 21,466.4. That is the way the NPV can be found. Friends, over here you can see that the answer is 21,403. This answer and this answer is like very near. It would be exactly the same if at all we take all the decimals. Friends, there are very rare chances that this kind of question can be, that is required to be answered using the real cash flow approach. But if at all we are required to do answer with the real cash flow approach, then in that case, step number 5 is going to be of course very important. In step number 5, we understand that say first of all the real cost of capital will be found for the first year and second year. Even in that case, the second year a real cost of capital is more critical. For inflow and outflow, you have to do it independently, separately, and then for the discounting also you have to be careful. Inflows will be discounted separately, outflows will be discounted separately, and then you're required to make the computation of NPV. And of course, the final answer is going to remain same, that since NPV is positive, you should purchase the machinery.